Hi everyone. Let's take a look at problem 9-8 where we will determine the cash flow effects of various transactions. And in this one we are trying to determine whether cash flows from operating activities will increase, decrease, or remain the same. Alright, let's look at that first transaction just to the left of my mouse. We purchased merchandise on account. Okay, if we purchase merchandise on account, then we receive goods and we owe someone an obligation to pay for them, but there's no effect on cash. Cash does not change hands. So let's drop in, how about an X that shows that's where we need to indicate the effect on transaction A. Now let's look at transaction B. We paid an accounts payable in cash. Well, if we paid an accounts payable in cash, that means we used cash. Transaction C, accrued payroll for the month, but we didn't pay it. Well, that means we recorded an expense, and the offset was to probably a payroll obligations or accrued payroll account. So again, in transaction C, it remains the same. There's no change. Okay, now let's take a look at transaction D. We borrow money from the bank, and the term of the note is 90 days. Well, in this case, although we are receiving cash, it doesn't have an increase in the area of the cash flow statement we're talking about, which is cash flow from operating activities. So in terms of cash flow from operating activities, there's no change. Instead, we would show this one as a financing activity. Let's look at E. We reclassify a long-term note as a current liability. Again, this is simply an accounting entry or a bookkeeping entry, but there's no impact on cash. So nothing would be reflected in the operating activities as a result of that transaction. Transaction F. We pay accrued interest expense. Well, accrued interest expense is part of our normal operations, and since cash leaves us, it's a decrease. Transaction G. We record a contingent liability based on a pending lawsuit. Here again, we record an expense, but the offset is to a liability account, right? A current obligation, but it doesn't impact cash at all. So there'd be no change. In H, we pay back the bank for money borrowed in D. Again, this is a financing transaction. It doesn't reflect the cash flows from operating our business, and the operations reflect our principal course of business. So there's no change here as well. Finally, the last transaction. We collect cash from a customer for services that will be performed in the next accounting period. So, in this case, cash is increased and we record a deferred revenue account, which is an obligation. But cash is increased, and since our primary purpose of our business is performing these services, it would fall into the operating area. So this cash transaction actually is an increase. Let me slide down so you can see that a little bit in case that was off of your screen. So the last transaction would be an increase in cash flows from operating activities. Okay, I'll slide back down a little bit, and that takes care of, slide up a little bit, and that takes care of this problem. Thanks, everyone.